I hope you have enjoyed and benefited from the last 2 days, from yesterday's sessions and meetings. Um, as you know, this morning we are going to have one session, a conclusive session for the SteelOrbis Spring 2024 conference and the 90th IREPAS meeting. And as always, this session is going to be a panel discussion with the chairman of the respective IREPAS committees. The chairman of the IREPAS committees will share the findings of their respective committees first with us, and then I will be directing the questions that we have gathered for them, uh, and we will listen to their answers. Obviously, you are more than welcome to direct your questions to the chairman of IREPAS committees. Let me start by introducing the chairman of the IREPAS committees. You all know them, but just to follow the procedure, let me start with the Raw Material Suppliers Committee, Mr. Jens Björkman. Mr. Doğan Baysal is representing the Traders Committee, and Mr. Murat Cebecioğlu is representing the Producers Committee, and he is also the chairman of IREPAS. So let's start by listening to the findings of the committees. Shall we start with the raw material suppliers, Jens?
Right. So, good morning. We're happy to sit down yesterday in the Raw Material Committee. The raw material side is, of course, this meeting is still a very important meeting for us. It's showing through the amount of companies registered. We were at this meeting 51 recycling companies, raw material suppliers, with 91 delegates registered. So it's an important meeting for us. And the markets are, of course, what they are. And this year has been somewhat of a struggle compared to the few years past. The economies are not performing as they were a few years back after the pandemic. The Western world, Europe and the United States, have been experiencing high interest rates, high inflation, and high interest rates, which has been putting pressure on investment activities such as building and so forth, which in turn then also has showed in scrap generation. So the scrap flows in most of Western world has been under a little bit of pressure, which of course then has had recyclers experiencing lack of material, lack of flow, lack of ability to make money. And markets, China was expected to rebound after the Chinese New Year with some stimulus activity, but instead the markets were a little bit disappointed, and it's showing that the Chinese economy is under a little bit under a period of normalization and evolving economy, becoming more efficient. Speculation in housing might not be the way to go going forward, and so forth. So this is also showing in raw material pricing and demand. Iron ore came off from highs of $120 to slightly below 100, and then also come back again lately. So it's been very volatile. We've seen exports of steel products at record high levels, not seen since 2015 and 2016. When it comes to the powerhouse India, outperforming most other countries when it comes to economic activity. We will likely continue to grow at a faster pace than China, and the demand for scrap imports has continued to increase and will likely continue to do so. The United States is outperforming the rest of the world. And despite of this, recyclers are feeling the high interest rates, which hamper investments and scrap flow. Scrap generation has been slower this year than last year. Demand, on the other hand, is growing, and steel installments will see a further 14 million ton capacity announced coming online in Canada and the United States. So demand for the raw material will continue to grow. In Europe, struggling economies under higher interest rates again. So this is the melody. Scrap generation has been down between 15% and 50%, depending on region and grade. And demand seems to be at a low point, perhaps. There were some ideas yesterday, at least, about, there's some signals that maybe we're at a low point, and interest rates are expected to be cut during the spring and in the fall. Could bring back some confidence, but otherwise the European sector is having a really struggling year. So scrap generation is slow, but on the other hand, demand in the domestic intra-trade European trade has seen a slight uptick. And Turkey is also under pressure from inflation and interest rates, which have doubled in the past year, and hurting investments, but of course necessary. So in general, the mood was hopeful of a return to something slightly more forward-looking and optimistic, but the current year is a tough one. So with that, I thank you.
Thank you very much, Jens. Shall we continue with the traders?
Sure. Well, good morning, ladies and gentlemen. At the Traders Committee meeting, like we always done in the past, we asked the attendees to send us their questions or subjects that they wanted to discuss in the meeting, and we take them and go over them and concentrate on those subjects. During this meeting, we noticed that the majority of the questions were concentrated on China, Chinese economy, and Chinese exports. We also had some few questions on new European rules for importing steel, in basically environmental protection in mind. It's called CBAM, or Carbon Border Adjustment Mechanism. We did have long discussions on it, which we probably will have this morning as well. We concluded that even though CBAM regulation will take effect in 2026, the importers and the mills are asked to start providing data, but their liability will start in 2026. We had long discussions on China. We all agreed that the export quantity of China will increase in 2024 and maybe go over 100 million tons. In fact, Chinese export volume rose by 14% in the first quarter of 2024, and ironically, the export value went down by 12%. In China, the biggest driver of steel long products is the real estate development, which is not healthy at all. Chinese Metallurgical Industry Institute predicts 1.7% drop in their demand in 2024, and this is after the 3.3% drop in 2023. We had discussions on Turkey and the limited markets left for Turkey to export, and like the traders did mention that they still have opportunities in Africa, in some Eastern Europe, and possibly Yemen. We also discussed the world markets in general, and overall, Latin America was healthy and increasing and steady. Middle East, except for Saudi Arabia and United Arab Emirates, were really quiet. Southeast Asia, also steady and growing, around 5% per year. USA is healthy and steady growth, mostly on infrastructure projects and renewable energy projects, all financed by or subsidized by the US government, which means the imports are not welcomed. And Europe was discussed as probably the slowest among all the markets that we have examined. This was all we have discussed. Thank you very much.
Thank you. And let's listen to the producer's findings.
Good morning again. Once again, as my colleagues did, we also gathered yesterday. There were 430 registered delegates from all around. In total, for producers, 41 companies and 104 representatives from these 41 companies were present. And we have discussed most, of course, in general, and my colleagues have already went through all what had to be said. But I'll be more country specific because all the producers from different part of the world we talked about in each country specifically. We started with GCC mainly. They are more optimistic of the future of the business. There are big infrastructure projects going on, especially in Dubai. There's a new airport project planned, which, if I'm not mistaken, it's about 128 billion dirhams, which is equal to about $35 billion. And it's said to be 8 to 10 million tons of steel to be consumed throughout this project. And there are many more going on. So business there seems to be okay. In Saudi Arabia also, as you all know, there is this big project, NEOM project is going on. Besides that, there are some other projects. So things there also seems to be on the right track. Kuwait, it's a steady market, about 1 million tons of consumption a year. More or less, it's expected to be in the same range throughout this year and next year. Egypt, my friends over here, we talked about it. It's getting better. They solved the currency issue because, as you all know, it was a big problem to import, to send the money and everything. So that seems to be solved at the moment. Inflation is expected to drop, but there was a problem because of the Red Sea problem. They lost a lot of money from the Suez Canal. I hope that will be solved. Tourism is good. Things seems to be okay at the moment. Talked about Canada. Inflation is down. There are imports mainly from US. There used to be many imports from the other parts of the world, but now mostly from USA, they said. There are new housing projects that might help a little bit to the market conditions. Next in line was Azerbaijan. Economy seems to be okay. Construction is the main driver, that's to be said. Russians are very active in the market. To find a scrap becomes a problem time to time. In Greece, there are two companies, three mills, rebar and wire production mainly. The rest is important. Market size is about a little over 1 million tons. They are also trying to export, but Turkey and Italy is a big competitor to Greece. But things are getting better in overall. Italy, things started to look good. Economy is picking up. Inflation seems to be under control. Consumption compared to 2008 is like 1/3 at the moment. Building renovations, EU supports infrastructure projects like railways, highways, ports will probably help in the coming months. Spain, Portugal demand is quite low, and there are no private investments going on because of the high rates. The economies are not doing well. Housing in general is an issue in EU, as it's already been said. And of course, we've talked about China. It's today's main talk is going around China and what they will do in the future, in the coming months. But they've been exporting heavily, as Jens pointed out. Probably they will reach the 2015 the highest levels. That's about it. Thank you.
Thank you very much, Mr. Chairman. So let me try to recap before we move on to the questions. So I understand for everybody, this year has been a little bit of struggle so far, as the economies have not been performing as they used to during the past few years. Obviously, high interest rates and inflation have been causing problems and issues in many countries for all the market players. I have noted that because of the adverse economical circumstances, the scrap generation and scrap flow has been under pressure, which is creating problems for the recyclers because of the lack of flow and lack of ability to make money. Obviously, the Chinese exports, high exports during the first quarter of the year, and disappointing market performance after the New Year holidays have been problematic for everybody in the market, traders, producers, and even the end users, probably because of the pressure on the market. I have noted that the demand for scrap in North America is growing thanks to the new investments. In Europe, the generation of scrap is down 15 to 50%, depending on the grade and the location. Hopefully, if the interest rates are cut in spring or fall, the market may see a positive change. Turkey is, of course, under pressure because of high inflation and high interest rates. The raw material suppliers are hopeful for a return to slightly more forward-looking conditions. That's what I noted, and I like that sentence. I have noted that there is a 1.7% drop in demand prediction for this year in China, which is obviously not good news. So yes, Southeast Asia is steady and growing. The market, US is once again healthy and steady growth is seen thanks to government projects, but obviously government projects do not allow imported materials, so that's not good news for importers. The GCC market is optimistic thanks to infrastructure projects in many countries. The good news I have heard from Egyptian market, the currency issue is solved. Inflation is expected to drop. The only negative thing is that Suez Canal issue is causing trouble at the moment, and hopefully it will be solved sooner rather than later. In Europe, the situation is improving slowly in certain countries like Greece, Italy. Inflation is under control, but unfortunately, there's still low demand in Spain and Portugal. So all eyes are on China, right? Thank you, gentlemen.
Name of the game today.
Yes, we have a lot of questions on China as well. So shall we start with the questions? Ladies and gentlemen, as I have mentioned at the beginning of this session, you may stop us at any time if you have any questions. So we'll be more than happy to hear your questions. Let me start with the raw material suppliers. In many countries, ferrous scrap is already defined as a strategic raw material rather than a waste product, and the problem is that globally there is not enough scrap. Therefore, countries are already beginning to compete for access to scrap, and this competition will increase in the future. In this context, how can long product producers ensure consistent raw material supply and manage their costs? What would be your recommendation?
Yeah, so I think the solution to everything is not scrap. Of course, when we see investments in regions towards electric arc furnace, like we do in the United States, Canada, or in the North American area, and also in Europe now, from previously blast furnaces. Going forward, we will see more electric arc furnace installments, as well as we see in already traditional destinations. So the likelihood is that we will see more regionalization of the scrap flows. We'll probably also see a slight added generation of scrap in the regions where scrap demand is good, and what we will probably have to see is alternatives to scrap, like pig iron, HBI, and DRI, and the producers of flat steel, which have been using more blast furnaces, are of course used to receiving iron ore, but in the future they will most probably have to use some derivative of that also. So and also quality-wise, it's not necessarily so that everything can be used in the local areas. So we expect markets to still need quite significant trade, and but of course it will be during the coming 10 years. The map of scrap flows will most likely significantly change.
And the usage of scrap will increase, because I noticed that almost all the investments are going into electric arc furnace versus the blast furnace, except for India and China. So
Right, but
there's a huge transformation to that direction. So there will be less availability of scrap to those people.
I mean, scrap is already being used, so it's not like there's big piles of scrap. Scrap's being used. It just needs to be transported further today, but in the future, we will most probably see less transportation, far distances.
All right, thank you very much. So let's move on to the next question, and let's try to dig the China issue. This question is for the panel. How will the situation regarding Chinese billet and longs exports develop in the coming period, with major Chinese property developers in deep trouble and reports of infrastructure projects being cancelled in China? Can we expect Chinese steel to flood the overseas markets, also bringing down the prices of other Asian exporters and as well as prices in the target markets in general? Shall we start with the producers?
Yes, of course. So we've already talked about it anyway. Well, I don't know if we could say floating the market, but they'll definitely be there with, I mean, it seems that way for the rest of the year anyways. As I've said earlier, and Ian said earlier, probably they'll reach high numbers as they did in 2015. They will also probably, I mean, the neighboring countries like Japan, Vietnam, Taiwan, South Korea will also be in the same boat, most probably trying to export to the region. Of course, especially the export-dependent countries like Turkey will be negatively affected. It's already been affected, but they will most probably be affected more and more because they've been selling from Europe to South America to everywhere. I hope it will not last long, but because their market, especially the housing market, is almost stopped. There is no stimulation or any help from the government. It seems that way at the moment. The rest, we hope for the best, but hoping is not helping today. So we'll see.
Thank you.
Well, I think the prices are already low. The margins are low, so I don't think that it will push prices much lower than what it is now because of at the end of the day, there's a real cost of producing steel. But I think if the China really wants, they can take over some of the markets, especially that's closer to them, like in the Southeast Asia and probably now more of Africa. And so really, if nobody can compete with China on price, and today really with quality as well. So when you have the price and quality, they can dominate any market they want.
Jens, any comments on this?
No.
No.
Nothing left to comment.
Well, we are talking about a potential repetition of high export volume from China, like in 2015. But there's a structural difference between 2015 and today. The Chinese have the markets available for the Chinese exporters are slightly more limited compared to 2015. So the impact might be a little bit more adverse. What would you think?
Yeah, correct. Because there's not market. There's not many. By then, the markets were open, like the exporters, like Turkey. Today, all those markets are somehow put under the protectionist measures. Like in US, you cannot sell Canada. Europe, you have quota. So we already have no markets left. So plus they are attacking to these markets, what is left of it. So it's going to be a more problematic for regular exporters to these countries.
It's going to be a struggle. Okay, let's move on to the next question. This one is for traders. China's non-VAT export trade has had a significant influence on the hot rolled coil markets. But what impact has it had on Chinese billet and longs exports? Does the reported investigation in China into the non-VAT export trade have the potential to limit the country's billet and longs exports in any meaningful way?
Well, I'm not the expert on the Chinese VAT trading, but from what I read and understand, that the majority of this trade is support is done on the hot roll coil and flat products. So the for the long products, billets, this is very minor. So the effect is going to be not so meaningful, I think.
Thank you. Moving on to the next question. This one is for the raw material suppliers. Yes. Iron ore prices were holding at the higher than expected level last year of $120 CFR for the benchmark 62% Fe content iron ore. But in the first quarter this year, prices already dropped below $100 per ton CFR before the recent rebound. Do you expect iron ore prices to drop below this mark again this year, or will strong steel production in China prevent that happening?
Yeah, so what we learned yesterday was that the weather was better than expected in China this spring. So there was a stronger flow of iron ore into China than normal for the season, and that's was also one of the factors due not only that demand was slow, it was also quite easily accessible iron ore, better than expected from Brazil, for example. So there's a couple different factors. There's the storage, inventory of iron ore in the ports has been quite high, and demand slightly slower. The daily production rates came down slightly. So these factors were all sort of adding up to bring down the prices quite dramatically. And now we've seen somewhat of a stabilization. Markets are adjusting to the current demand level. and then we saw also a rebound in the iron ore price almost back towards these levels that were before the Chinese New Year. After that, the expectation was that markets would perform better and demand would be stronger, but it was not. So, and that was one of the factors also for the prices to come down. But going forward, China is also saying that some of their exports are to cover Russian fallout. But yeah, the expectation is that markets will continue to be at quite a high level in China. Yeah.
What is the historic level of iron ore price? I know it goes up and down, but there must be some area, let's say in the last 2 years.
I mean, this been fairly stable at the 102.
more or less,
Yeah.
in that particular
Back in
range.
the
But
same
of course,
area then.
we had seen the prices going up
Right.
about 200 and back down to $15 or so.
And you had freight rates also going very high, haywire last year, and
Right.
so.
Thank you. So next question is for the producers. Longs and semis export volumes from the ASEAN region remain at a high level. How do you see the increased competition between ASEAN and Chinese sellers impacting suppliers in the rest of the world?
It will definitely impact the rest of the world, that's for sure. Together with China, already in Malaysia, Indonesia, Vietnam, they are heavily exporting today, as you all know, to all parts of the world together with China. There is also probably they are competing with each other. That will definitely impact the supply rest of the world. As I have just explained in the previous question, Turks will definitely be, I mean, as we are one of the biggest exporters of long products, we will definitely be, we are already feeling the effects of it, but it will be more and more. Suppliers will be impacted by all this activity from Asian and Chinese exports.
There is no
Much to add
escape
on
from
this,
that.
I don't what else to say.
Thank you very much. Any other comments? No. So we are going to move to other geographies with the questions. So if there are any questions from the floor at this point? No. So moving on to the EU. This one is for traders. Safeguard measures on steel product imports into the EU are set to expire in June this year, and the European Commission has started a review investigation. Do you expect the measures to be terminated, or will there be any adjustments regarding the quota volumes?
Well, I think the safeguard measures will continue as it is today. There is a lot of push from the steel mills in Europe to their governments. So they're going to find political reasons or conversion to the green steel. They'll find some excuse to extend this for another 2 years, is what I think. Now, as far as the adjustment of the quotas, I think that may be minor. From what we discuss, it's probably going to be around 4%, if any.
As I read it a couple of days ago, I think already 14 countries have applied for extension of this quota system, whatever.
When it comes, it
Most
doesn't
probably
go away
expand.
because they like it, you know. And then they, funnily, they invest thinking that these quotas will be there forever. So, like
Maybe until CBAM's.
yeah, CBAM is exactly the extension of the same, because with CBAM, it's going to be very hard for the other nations, especially the ones who produce with blast furnace. Almost, they will have zero chance to come to Europe. So even for the countries like Turkey producing with majority with scrap, they're going to have difficulty because they all have to have an adjustment of the CBAM value, which is really determined weekly. It's not like, you know, in anti-dumping, we have one number, we know that, and we adjust to that. This is a number floating weekly, so you and will be measured in dollar per ton, or depending on how much carbon dioxide they use, or their carbon footprint. Very difficult formula. It's very hard for the even the mills to follow, and not to mention the traders. When I was discussing with my trading friends, they said, "Oh, this is great for the traders because the mills cannot really cope with it and become the importer on record, and because you really have to be an importer on record to just bring this to the country." But I think it's difficult in many ways, and it's a serious liability onto importer on record to Europe, because it's a floating, never really one number, and it's kind of arbitrary in my mind, and and it's an expensive, because it's going to be additional, I don't know, 50 to 60 euro per ton on whatever the price they're trying to sell at that time. So, uh, how would you know how to really figure out your time? And really, especially for those who are trying to bring cargo and hold it for the first quarter or the second quarter and all that, it's going to be so difficult. You may hold it there for another month, but then you realize that your CBAM number went up, and so your profits are gone. It's scary.
It is. It's going to be a learning curve for many, many, many market players. Thank you very much. Moving on to the next question. This is for the producers. How are European long producers managing at present given their higher costs since the war in Ukraine began? How serious is the threat they face from cheap imports from Asian producers with lower costs? How have their margins been impacted? What kind of reactions do you hear from your European colleagues?
They have negatively impacted already, and plus, especially northern part of Europe, like Germany, Holland, Belgium, the demand in that area is very, very low. I was also talking to my friends from that region. We were in the fair a couple of weeks ago. They've been really hurting a lot. So the price is also very low in that region. And plus, these exports from China really affecting everyone, as I've just explained, especially the big exporters to the region. Most of the exporters to the region, besides the European Union, anyway, you have quota, you have to deal with China, and besides China, you also have to deal newcomers like GCC, North Africa. They are also exporting to Europe. So things will be tough for at least throughout this year. But hopefully, that's what people are thinking about. Starting next year, things will pick up and be better.
Would you expect new quota limitations on further quota limitations on the newcomers, mentioned newcomers in the coming period, starting from July?
We will see. So everything is political. I don't know how to answer to these questions, but they'll definitely extend our quotas for Turkey, and probably they will also put new quotas for the newcomers, as they, I think, didn't have it for Malaysia, Egypt. I think they will also have to be included in the next turn.
Thank you. Next question is for the raw material suppliers. Do you foresee the possibility of European scrap exporters cutting sales to Turkey and increasing supplies to their own regional market? I think this question is also takes into consideration the CBAM.
Yeah, and also I think an effect also of the shifting of blast furnace production towards electric arc furnace in the next, I mean, after 2032, it will be very challenging for Europeans to produce steel from a blast furnace because of the very high cost of carbon dioxide emissions. So you will see a lot of scrap, especially cleaner grades, being used more in the European sector. So it's expected that the 20 million tons of exports or so that leave the European Union or the EU 27 will most probably be lower, or maybe it's still high, but the amount of exports will be lower from the EU expected.
I'm curious, what is the percentage use of the blast furnace in Europe today? Percentage versus the
I think
scrap.
it's about 50-50.
Oh,
There are others who know that much better.
because for them to impose those, first they have to look inside and look at their numbers, right? When they call the CBAM and puts duty on
Green.
the world market, they have to look at theirs because I don't think they're gonna cut their
But the
blast
cost of
furnaces
the cost of
overnight.
carbon dioxide emissions will make their own production
More expensive as well.
unprofitable. So you will see the European sector need to shift some of their blast furnace production towards electric arc furnace. Or try to handle the carbon dioxide emissions somehow through innovation in blast furnace technology or carbon capture or something like that.
Obviously, there are several different support programs within the European Union for that kind of conversion, right?
Right.
So thank you very much. Moving on to the next question. This is for the producers. Not so much is heard nowadays about reconstruction works in Turkey's southern region, which was devastated by earthquakes in February last year. What's the current situation regarding reconstruction activity in the region? Is sufficient finance available for reconstruction? Has domestic steel demand in Turkey received any significant boost from the steel needed for reconstruction in the region?
Well, construction activity has already started south of Turkey. It's going on. There are also new projects coming up one after another one. Of course, mainly the mills in that region are benefiting from all this. But since the export activity is very low and limited, this is also giving to these mills a little bit of a break. These projects are also supported by the government, so funding should not be any problem. Well, it's going on, and I think they will keep doing it because it needs to be done. And there are many people are affected, as you all know, from this unfortunate earthquake. So I think things seems to be in the right track and will keep going on.
Thank you. May I add another question? Actually, this is Alex Gordienko's question yesterday during
Yeah.
his presentation about the increase in Turkish output. How would you explain that?
First quarter of this year was much better than the last quarter. I mean, last year's first quarter. I think that was due to because we had a lot of sales to Europe. It was considerable amount compared to previous year. Because first half of last year we were not able to sell anything due to Egypt was selling a lot of material, Algeria was selling a lot of material, GCC was selling it. This year in the first half, in the first quarter, that did not happen. So we had the room to sell to Europe, and we sold quite a good volume. That should be the reason. It was the opening of a quota also. Now we cannot sell because especially the quota for wire rod is already filled up. There's a little bit of room for rebar, but there's no demand. So we'll probably sell again in June to be there very early. I mean, end of June, so the people in Europe could clear the material 1st of July. That's about it. Yes, correct. We did sell.
Thank you. So, next question is for traders. The Turkish steel industry was already caught between a rock and a hard place with its high costs and the weak demand from its domestic and export markets. The geopolitical situation in the Middle East region is hampering Turkey's sales to its two leading rebar export destinations, Israel and Yemen. Moreover, there are safeguard measures in the US and quota restrictions in the EU. How do the traders see the chances of Turkish steel exports emerging from the current impasse?
Well, this is all true. The situation for Turkey is not good at all. I think what they have to do is talk to their government, and their government should work with the rest of the governments where they have the quotas or restrictions to be lifted. It is political and it has to be done. The mills by themselves really can't do much on their own. However, there's still some opportunities for Turkey. They're exporting, some to the neighboring Syria and Iraq from the south, and they ship a little bit to Eastern Europe, and they have some markets in Africa. But this all will not be enough for Turkey. They really have to have their government, get involved and work with them to open up some barriers.
Anything to add, Mr. Chairman? No hope.
Not really. Yes, correct. It's a big problem. Safeguards, U.S. anti-dumping case, especially Section 233, 25%, which is totally political. There is nothing we could do about it. On top of we have these anti-dumping case that will be solved, but it will take minimum a year or so for that to be solved. Canada, you don't know what Canadians are doing. It's very strange. They have something called minimum value. They give you a minimum value where you cannot sell below that number, and that number is quite high today. So there's no way you can sell above that number. And EU, it's the quota, and most of these are very much political, and we have no control over it as the mills. As he says, it's up to the governments to make this right, but it doesn't happen from here, one day and to the next. That really doesn't happen. We hope for the best and just waiting to see the outcome. There has been many attempts to do this, and the government level and everyone, that's still going on. But now there's going to be elections in the states come November 5, and see what's going to happen.
Like Section 232 you mentioned, it's definitely political because when it was first introduced, it was a level field. Everybody was 25%, and that was kind of fair because it's helping the U.S. economy. Kind of made sense. But then they said, naturally, we'll exclude Mexico and Canada. We said that's quite all right too, because they're our main trading partners. Then they said, well, Australians are nice people, so they are exempt. Okay. And then they said, well, Argentina exempt with when they increased Turkey from 25 to 50%, the reasoning was that there is a high inflation in Turkey. Well, there was higher inflation in Argentina, but they were exempt. Then they said Brazil is exempt. Oh, Korea is exempt. When Korea is a major factor in U.S. Then they said, okay, Japan is exempt, and finally they said, well, we'll put some quota, but Europe is exempt. When I look at the map, I see the Islamic countries, including Turkey, are not exempt, except for China and, let's say, Russia. All the Middle Eastern countries, including Turkey, are paying 25%. The rest is exempt. So it really is not, it has nothing to do with economics. It has nothing to do with the U.S. And funny thing is, when you increase the 25%, immediately all the U.S. mills increase their prices 20%. So then the prices in the U.S. went up, which is part of our inflation. And then when they excluded these countries, none of them really sold at the base price. They all said, okay, US government gave us a privilege, now let's use this. They increased their prices 15 to 20%. So overall, the prices in the US still is up by 15 to 20%. And these countries that they don't prefer to bring to the US, like Turkey, they have no chance. Sad. So it is political. That's why I said the only thing that Turkey can do is talk to their government and try to get some concessions with the United States.
We'll see. Thank you very much. I have one more question on Turkey, and this is for the producers. Many Turkish mills have already expanded their wire rod production capacities. Do you believe they will focus on niche markets with value-added products, or will they continue mesh grade wire rod sales to the European market? On a separate note, Turkey imposed a temporary safeguard measure of $175 per ton on wire rod imports in January, valid for 200 days. Do you think this import duty is still necessary, and will it have to be extended?
Let me start from the last. Yes, I think it is necessary to have this because there is enough capacity of wire rods in Turkey. By importing from Malaysia and I don't know from Indonesia, Vietnam or whatever, from China, it really affects the local mills, the local production and everything. So this is necessary, and it creates a quite difference in prices. Yes, correct. There are new mills, wire rod production capacities are increasing, coming up. That's correct. But you know, when the markets are open, again, there is no market to sell to. It's very limited. That's the big problem. Otherwise, for example, EU quota for wire rod is over in the first week of its opening. So there is enough sales. There is for wire rod. There is enough demand. Also, Israel buys good quantity of wire rod and deburring coils, which was our number one market. Hopefully, will come back very soon. So things for wire rod to European market will continue, and hopefully the quotas will be lifted soon, so we could do more business there.
As I said, we'll see about that. So we are moving away from Turkish market. Any questions from the floor at this point? No. So next question is for the panel. To what extent has the shipping crisis in the Red Sea affected freight rates worldwide? How do you think this situation will develop? Are there any improvements already, or are these higher freight rates here to stay? You have mentioned
Egypt was affected very badly for
Yes.
this, and as it was discussed yesterday, I mean, countries specifically depending on this. Of course, Egypt is being one of them, and they were very badly affected. And also, you have rightly said, people are not really feeling comfortable to go through this region. They really don't know what to expect. So very hesitant to do any business to that location, to go through that location actually. Yes, because otherwise they have to go through the South Africa, through all that, they have to go through that, and that increases the prices. So correct, yes, the prices it increased a little bit, and if it, but I don't think this will go on like this. They have to find a solution for that.
I think the prices already have come down from the original when it went up, because when this whole world started October 7 and the Yemen decided to interfere, the prices went up dramatically. Not only the shipping price went up, our insurance prices went up as well, and to a point where it affected the container shipment a lot more than the bulk shipment. We had to change our shipments from container to bulk, which means we had to increase the quantities, and the additional cost was things coming from, let's say, the Southeast Asia, and mostly coming from, let's say, United Arab Emirates, had to go through the South Africa, and the additional transit time was between 15 to 20 days. That is an additional expense on interest on your shipment. So the prices went up, and the container rates went up dramatically because four different companies really control the whole industry. So they like to use any excuse to increase the rates. Now, recently it has come down some, but is not back to the way it was before. So it is cheaper comparing to this high rates. It came down, but it still is a bit higher than before. And I understood the insurance rates are coming down as well. So it's not normal, but it's the new normal.
Thank you. Rami, anything to add? No. Okay. Jens?
No, I agree with Don. The surcharges for in the early stages of this Houthi rebel attacks in the Red Sea was around $1,000 a box for the containers. It came down after a month to 500. In the last 3 months, it's come down to 300, and it's on its way back towards a more normalized situation. And that's also meant that a lot of the scrap that was previously shipped in containers to South Asia stopped for a while, but is now back going back into boxes from the UK, for example, and the continental European sector again towards South Asia. So we've seen a more of a normalization of the situation, although it's not resolved. We still see a slight more normalized situation.
Cargo carriers stopped going through the channel this first one. They were going through the other way around from South Africa. That's why the
Cape.
prices were quite high. So now things becoming a little bit better because some of them they go through this.
It's of course not free to go through the Suez Canal either. So it's okay, you lose 14 days going around, but the difference in cost is not too large. It's you lose time, but not too much money.
Well, it adds up. All those adds up, and besides, you have certain contracts to deliver in certain time period, and suddenly you just can't meet your contract. If you don't meet your contract, and if the price is already on a decline, you are in a serious bond. You know that unfortunately is part of the risk that the traders do take every day.
Thank you very much. Moving on to the next question, which is for traders. Russia has lost its share in regional markets in most segments like flats and semis, but its long steel product sales, especially to the MENA region, are still decent. How do you foresee the further development of exports from Russia in different products and regions, also taking into account that Western sanctions may only tighten further?
When you look at the numbers, looks like Russia is still continuing selling to the same areas that they've been selling since the war started. I don't think it's going to change. Middle East is their good market, and so is neighboring countries there. I I noticed that the day that Turkey really put a sanction on Israel, a large volume of rebar immediately were contracted to go to Israel as well. So life goes on.
Thank you. Next question is for raw material suppliers. Jens, a classic crystal ball question. How do you foresee raw material prices trending in the coming months? Will they continue at the current relatively low levels, or what factors may tip them back into an upward curve?
Well, you can either be optimist or well. In general, the situation, as I said earlier, was also that in the European sector, the scrap flows have come down quite significantly due to low economic activity. So that's one factor, and then we see a slight uptick in demand in long producers in Europe again, which for the past year has been very sluggish. So there's a signal at least that there is a little bit of a slightly better market in the intra-European trade, and that normally means that okay, there's a low scrap availability and demand is slightly higher, so that would be a positive sign for scrap pricing, at least in the European sector. So and what we see in the US is maybe that the economies are doing well, a little bit a better scrap generation on the exports perhaps. So it's a very challenging, it's very difficult to say what scrap prices do because it's not just it's not an easy math, but if you look at futures pricing, it's very stable around these levels. And also if you look at the Turkish trade, and if prices move up $3 or $5, then all of a sudden there's quite good supply, a lot of supply coming out, also dampening the pricing. So that's what we've seen in the last few months here, is that prices around these levels, 380 to 390, between 380 and $400 perhaps, is where the market feels fairly comfortable. It's able to make ends meet. So it's the sense is that we are at a fairly good balanced level at the moment. But if the prices come down $5, then availability is removed slightly. But also if you look at the European pricing, it's relatively high in Europe compared to Turkey at the moment. So it signals that the demand is slightly higher.
Thank you. How do you evaluate the up and coming Indian demand?
We've seen India go back and forth in the market quite a lot in the last few years. Last year there was a spell of quite significant buying, which meant that Indian pricing was a lot higher than, for example, anything else in the world, which we're not very used to. But with the um, Red Sea issues and longer distances, higher freight rates, it's also a little bit challenging to do for Europeans at the moment. But correct, we've seen a higher demand for bulk shipments also from India this year. And going forward, we'll likely see India continue to increase demand as their capacity installments is adding.
Thank you very much. Next question is for traders. How will ongoing trade tensions, global conflicts, and political instability affect the supply chain and overall stability of the steel market? You have already had a lot of comments. Anything to add?
Well, I guess what it does is it makes the buyers mostly and the mills try to sell locally. So this whole changed the way people buy and sell, and the trade become more local than really international. In the past, we used to buy from one continent and send to the other continent, but today most of the trade is local. Like in the US, majority of the trade is from Canada and Mexico, and South America is the same. Majority of the buyers in Central and South America buy from Brazil and Mexico. It's so really for the other traders hard to get in, and so and even Europe. In Europe, I noticed that the trade is within Europe rather than buying from anywhere else. So what happened is this global trade is becoming more local trade.
Thank you very much. I have got 4 more questions. This next one is for the panel. What's the expected impact of the active capacity expansion in the GCC on the regional longs and billets markets? You have already mentioned
Huge
competition
projects in
from GCC. Yes.
There is also locally things are going very well. I was talking to my friends in Dubai, in Emirates Steel. They say they are not exporting at all nowadays because the local market the prices are quite well, and it's satisfactory enough volumes available in the market. So yeah, so things are seems to be okay in GCC. We talked about it, and
Quite a lot of government
lot of
project,
job
infrastructure projects.
exactly enough for the region itself. Seems that way. I don't know.
But we saw some shipments from the United Arab Emirates all the way to Canada.
Yeah, from mainly in Conares is shipping.
Yeah,
It's another mill.
exactly.
A smaller mill compared to.
So they are looking for other sources. I have to admit that I get more calls from that region
Correct.
to sell to the US than any other right now.
Oman is selling huge.
All of them.
Oman especially selling a lot of material to Europe.
Yeah, we get more calls.
Good. So, next one is for the producers. How do you view the current situation as regards the option of billet versus scrap for EAFs, and how would you compare EAFs and BOFs at present in terms of production costs? How do you foresee this picture developing in the next 6 months?
It's a difficult question to answer to. I really don't know the price, cost, how they calculate this. But in these days, it's if I know billets been purchased in Turkey from Far East, China, Russia, because price was much competitive pricing compared to when you buy scrap and go for the rebar. Uh, there were a lot of buying for billets, so it made sense. Whenever the price seems to be okay to buy billets, people will go for it. But for the rest of the pricing, cost calculation of electric arc furnaces compared to BAFs, I have not so clear about it. So it depends on the iron ore prices. It was very much down. Now it went up again to under
There's a
20
lot of
levels.
volatility, yes.
There's a lot of volatility going on. So it's very difficult for me to say anything about it. If somebody can.
Well, I mean, I guess if you say the next 6 months, with the lower or prices of the iron ore, and so I think that blast furnaces definitely has an advantage. But in the long run, as the world is changing with the new, environmental regulations going on, and also the cost of money. So obviously, when you want to build a mill, the capital investment on a blast furnace is much, much higher than having a electric arc furnace. So in the long run, you do not want to invest in a blast furnace as it's not going to be as economical, and it will be restricted market for it. But in the short time, I think the blast furnace definitely has an advantage.
I don't know the exact cost calculation, so that's why I don't want to say anything.
Capital investment is like
No. I mean, just
multiples of-
costing to production cost. I'm talking about.
Oh.
I'm not talking about the cost of building the whole mill.
look at the price that they're selling, so they're always undercut you.
Yeah.
So it's I guess a factor of energy. If you have good electricity and able to use the electricity, then maybe it's easier. But okay, so in the Western world, it's much easier to use an EAF than in some of Asian countries. But you also see now I think over 150 new blast furnaces coming online in the Asian market. So it seems to be still a valid route.
Well, it kind of makes sense for the Asian market. Like I said, they have a difficulty getting scrap, and they look at the future. They have raw material readily available or easily available coming to them. When you build such a new big investment, you have to think about the raw materials that's coming in over X many years. So it's not like today's price. It's what's going to be 20 years from now, because those investments have to have a long life, like 30, 40, 50 years. So they have to look at that. When you look at that, then obviously, they have to look at and say, okay, will I have that much scrap coming into my mill and to do it? And do I have a sustainable local market? Because one of the key things is they're going to sell the majority of what they produce in their own market. It's a different situation in Europe. I think Europe is going to disinvest from that, going back to scrap, especially with their new environmental regulations.
And also perhaps not as necessary to run efficient huge production levels. You can use quite a lower production.
Sure.
The market is a little bit saturated.
Thank you very much. Last couple of questions. This one is for raw material suppliers. What's the current situation in the financing of trading of scrap and or other raw materials?
Yeah, so at yesterday's seminar, we were sitting down, and it seems to be a lot more challenging, especially in the steel industry has also lost a little bit of credit insurance. So the market is under pressure from high interest rates, and credit insurance is also being limited due to lower earnings in the industry. And so there's multiple factors that are making the trade a little bit challenging at the moment.
Thank you very much. And last question I have here is for the panel. And let's try to summarize what's going on in the market. The general sluggishness of demand seems to be the main problem plaguing the global longs market at present. In the US and the EU, we see high interest rates and poor residential construction performances. In China, the property sector has taken a hit and some infrastructure projects have been cancelled, while in Turkey, finance is very difficult, to name just a few markets and issues. Do you think this situation regarding demand will continue for some time yet, or when do you foresee the tide turning and global demand finally gaining some genuine momentum? What factors will help bring this about? We have already discussed the first 6 lines of this question.
Exactly.
Maybe we should focus on the last 2 sentences questions. Who would you like to start? Would you like to start?
Yeah, okay. When to say when this is going to come back, it's quite difficult, as we talked in the first 6
Yes.
lines of this. China is important, what they will do, because for the demand, again, there is kind of a demand, but for especially Turkish long product producers, it's been blocked by protectionist measures, as we have just talked about it. For the real demand to come back, it's going to take a little while. And the competition is tough, not only Turks and many players in the market trying to export where is available. So, and also some of this is political. That's not something we can control over. We have control over. So it's quite difficult to say, but throughout this year, I think we're going to see more or less the same levels for exports or for demand.
It's certainly not only about steel. Huh?
Yeah,
Yeah.
when you look at the higher interest rates, it definitely affects, especially for the, I can talk about the US market. The residential construction industry is highly affected because people cannot afford to buy the same home that they used to buy, let's say 6 months ago or 8 months ago, when the interest rates rose from 2% to almost 8% for them. So that made a change. But with all this, I think this became, you have to look at the world in different regions, and different regions have different characteristics. Like in the U.S., the majority of the investment market is doing well. Everything looks good, but where the money flows is the infrastructure projects and the renewable energy projects, and definitely military projects. So all this is limited to really domestic use of the the steel domestically produced and used. South American market is actually doing well. It's doing fine, and there is a growth in South America and Central America, but also it's dominated by the Mexican and the Brazilian producers. So it's within them. When you look at the Southeast Asia, I think that market is doing average and fine as well, but dominated by China and the local producers in that area. when you look at Middle East is not doing so well, but there are some big projects. But looks like those big projects will be also supplied by locally, so it's not really going to add much to the world trade on this one. So there is global demand, but it will be supplied locally mostly. Not much good news for traders like us.
Jens, any additional comments?
Well, I mean, we see now, of course, okay, we listened to the economist from Commerzbank yesterday. He was a little bit pessimistic on the rate, the speediness of interest rate coming down, higher for longer in the US, perhaps, and but what we see in Europe is probably that we will get some interest rate cuts in the next few months, and that could be a sort of a relief factor, at least for the EU. And I expect that we will see in the next 6 months also from the United States federal the Fed, that we'll see slightly lower interest rates, maybe not as low as markets had expected, but at least lower, and should fuel and give some energy back to the markets. Of course, it's been used to tame inflation, but the activity and investments might then be able to be coming back into into markets and give a little bit more energy and demand. So going forward, perhaps 2025 should be slightly better than 2024.
Hopefully.
We all thought that interest rates are going to go down by now in the US, but even on the fourth quarter, I don't think it's going to be more than 0.25, just to show a goodwill before the elections. We have the inflation that's really still there. So if the central bank is Fed is really looking at this whole event non-politically, which is not anymore, then they should really leave the interest rates alone, which means it's not coming down anytime soon, unfortunately.
Thank you very much. This was the end of the questions I had in my hand. So are there any questions from the floor or any additional comments? Can you have the microphone for the gentleman there?
Hello. So I'm pretty new in the business, but it's quite a silly question. You see, for the GCC market, as I see, and the local demand is going well for the UAE. But what happens when these projects don't come about? Like either them continuing or doing more projects, then the local mills might want to export, and it might affect like other markets which they're close to in that region. And do you see that as a threat for like, I don't know, like in the future, let's say 5 years from now or later on? And will this have any other impact on even maybe the other continents affecting global trade and not just in that region?
I can tell you this, as long as there is surplus of money in that region, there will be some advisors who will advise them to do more projects. Whether they make sense or not, they're going to make sure that that money is invested and spent. They're going to sell them some dreams. And when you have the money, you have advisors giving you great advice.
And when UAE says they're gonna do something official, they will definitely do it.
That's what we have experienced during the past few decades, right? So thank you very much. Any other questions, comments? No. All right. Gentlemen, thank you very much. Thank you very much for all the comments, all your thoughts that you have shared with us. I also would like to thank you all for your attendance and for your participation during these 2 days. I also would like to thank our distinguished speakers who have shared their experience and information, opinions with us during the course of this conference. Obviously, last but not the least, I'd like to thank our sponsors, starting with İçtaş, obviously, SİEK Group, Ekinciler Iron and Steel, Alex Stewart International, Belgian Scrap Terminal, De-Risk Business Solutions, Almet Holding, DFC, Link Inspection, TPI Group, QSS, Soybaş Steel, and Stalex for their unstinting support, as always. I hope we'll be able to see each other in Paris in September. I wish all of you a safe trip back home. Thank you very much, and hopefully see you in Paris. Thank you.
Thank you.